Great. Thanks very much indeed. Good morning, everybody in Fingal. Um, I'm from Frank Green from Forvis Mazars, and we're delighted to be able to participate this morning by way of this webinar with yourselves. So we have set out there the topics that we're actually going to cover, which is really a couple of updates around some matters on some general VAT points and some stuff on the Carson case, which was to do with whether people are employed or self-employed, and then some a roundup of general POI matters and what's going on with the revenue commissioners in the current environment and looking forward over the next year or two. So those we've set out there the points that we're going to cover. So just in terms of who Forvis Mazars are, we're a firm of tax advisors, accountants, auditors, consultants, corporate finance people, broad range of services. We have 4 locations in Ireland with multiple locations around the world as well, so we can link in wherever anybody needs. That gives you some details on our geographic footprint in relation to it as well. So in terms of the nature of the work that we do on the tax side of it, we provide a wide range of services from corporate tax structuring, group structuring, revenue audit support, VAT, employment taxes, international tax, succession planning, M&A tax, global compliance, country by country reporting, management reward and incentivization. That's just a broad range of the tax services that we actually provide. So in terms of the team who are here, as indicated, I'm Frank Green. I'm a tax partner here in Forvis Mazars, and I deal with a range of work, a broad range of work, everything from corporate tax to succession planning right through to tax audits, mergers and acquisitions. And I'm delighted to be joined by my colleagues, Jeff Johnson. Jeff's a tax manager here, dealing with corporate tax in the main, and Kieran Ahern. Kieran's a VAT director, so Kieran's going to deal with the VAT aspects of what's actually happening here. So that's the team that's actually going to present. So first up is Kieran Ahern, our VAT director, and Kieran is going to give us some details of what the current pitfalls and opportunities are within VAT. You know, some practical stuff rather than technical. So hopefully everybody will get something from it. So Kieran, I'll hand over to you.
Great, thanks very much, Frank. I have to say I'm absolutely delighted to be here after a couple of IT issues there earlier on, with links coming through from the IT team here. So it was a last minute rush to try and get through, but I got here just in time. So thanks very much everyone for joining. As Frank said, I'm going to look at the some VAT aspects that I'm covering this morning. So I suppose I want to talk about three topics in general. I suppose I want to look at some recent changes that have come on in the last number of months. I'm going to look at some VAT pitfalls and opportunities at a kind of a high level to give you maybe some insights or assistance rather than deep technical stuff. And then I'm just going to finish up with some upcoming deadlines that are coming down the track for the next 6 months or so, just to outline those for you as well. So in terms of recent changes then, the first thing I want to talk about is some VAT rate changes that have come into effect or that are going to come into effect. And the first one is around the hospitality and hairdressing services, and that's moving from 13.5% back down to 9% with effect from 1 July 2026. Now that's going to affect your cafes and restaurants and catering operations, but it is also going to affect your hotels. But there's a bit of an added complexity for hotels here because the catering element of hotel operations will move from the 13.5% to the 9%, but the accommodation part is staying at the 13.5%. Whereas in previous iterations of this VAT rate change around the hospitality sector, the full amount changed, but it's only the catering operations are moving in this particular one. So there's an added complexity there now for hotels where, you know, they're going to have to apportion, if they're involved in, say, bed and breakfast, they're going to have apportion the charge between the accommodation, which will be 13.5%, and the catering, which will be at 9%. Another change then for the hotel sector is that from 1 January just gone, the non-accommodation hotel room hire is moving to, or has moved to 23%. And what this is looking at your function room hires in hotels. And the reason for this change is that previously all room hire in hotels was at 13.5%. But if you were hiring a room, say in an event center or somewhere that wasn't a hotel, they were subject to VAT at 23%. So there was a bit of a mismatch or a disadvantage to other sectors compared to hotel around event center spaces. So the idea here is that they're just leveling the playing field in terms of moving room hire for events in hotels to 23%. As announced in the last budget, the 9% rate for gas and electricity is extending out to 31 December 2030, which I think is a welcome bit of news for people, given that the costs of electricity and gas is remaining so high that the 9% is in effect here now for the next 4 years or so. The VAT rate on new apartment sales was reduced as well to 9% from 13.5% from October 25, and that is going to remain in place until December 2030 as well. Post the budget announcement on that, then in November, Revenue also confirmed that the construction services for apartments and the site sales for apartments are now also going to be liable at the 9% rate. And just if you're involved in that space, I suppose there is specific definitions of what constitutes an apartment block for the purposes of getting the 9%. In other words, it has to be a multi-story unit, and there has to be at least 3 apartments with group or common areas as well. So you just need to be careful on the actual definition of an apartment for the purposes of availing of the 9% rate. On that as well, if there is an element of commercial element, say downstairs and apartments up overhead, obviously the commercial element will not be subject to the 9% rate, and you have to do an apportionment in those type of situations as well. Just then, as I'm talking about rate changes, I suppose, in any situation where there is a rate change, regardless of the industry you're in, if there are rate changes, you have to look at more than just, okay, there's a change in VAT rate. What are the implications? So you have to look at updating your systems, your pricing models may change. You have to consider the time of supply and what VAT rate applies depending on when the supply is made. If you're looking at deposits, what rate is applicable when there's rate changes, and also in credit notes for invoices that were previously issued, you need to consider, well, what's the rate in place for those type of things. So just keep those in mind whenever there's rate changes in any of your businesses, that they're the type of things that you have to consider as well. Then in terms of what's coming down the tracks, in terms of other changes, I suppose the major one really is to do with VAT modernisation and e-invoicing. And broadly what this involves is businesses over the next 3 years or so are going to be required to issue e-invoices for domestic business-to-business transactions and report those transactions almost like a real-time reporting to the Irish tax authorities. So this is being done in 3 phases, the first phase being introduced in November 28, then phase 2 in November 29, and finally full implementation is intended by November 2030. Now, what Revenue have said recently is that, well, phase 1 coming in November 28 for e-invoicing is going to be only for VAT registered businesses that are managed in large cases division. So if you were a business and your interaction with Revenue is via the large cases division, you were going to have to be up and running for e-invoicing by November 2028. And as I said, it's been done in 3 phases. Phase 1 and phase 2 initially are going to be for domestic business transactions. You're going to have the capabilities to do real-time reporting and report that to Revenue. And phase 3 then, from November 30 onwards, all invoices for intra-community transactions are going to have to be done via e-invoicing and reported to Revenue. So what are the implications for your business then in this scenario? Well, if you're involved in this space or you're doing any activity in terms of intra-EU, you're going to be coming in within the e-invoicing regime by 2030 ultimately, and maybe before that, depending on whether you're in large cases division in 28 or all businesses from 29. So you're going to have to undertake a comprehensive assessment as to how the changes are going to affect your operations. You're going to have in place the necessary technical infrastructure, data management capabilities to capture and store and exchange and report e-invoicing. So it's going to require early engagement with your IT and finance teams. Obviously, external advisors are probably going to be brought in as well to ensure a smooth transition of this e-invoicing protocol that's coming down the line. In terms then of the benefits for businesses, I mean, if you stand back from it, you'll say, well, if this thing is going to be all automated, there should, or you should in theory anyway, at least see some substantial time reductions and efficiencies, which should result in cost reduction. You will have more accurate and timely VAT reporting. Revenue were saying that because everything will be automated, you will have faster processing of VAT refunds, reduced likelihood of compliance interventions because revenue will already have this information provided through the invoicing portals. And then real-time reporting should allow for more focused areas in terms of high-risk areas. So it should ultimately increase your VAT compliance profile. And I suppose the key takeaway just in terms of that deadline is, look, November 28th may seem a long way away, but there is a number of steps that you should be doing to start the process. And we would recommend that, early engagement is required to get this moving. If you do find you're in large cases, November 28th is your deadline. And if you're involved in any intra-community business, November 29th is your starting deadline. Coming on then to some VAT pitfalls and opportunities. And again, as Frank said, I'm trying to look at this from kind of a high level rather than deep technical drill down. I suppose the one key takeaway I would take is that, from the pitfall side of it, there are almost limitless ways in which errors can arise when it comes to dealing with VAT. But some of the more frequent ones that I've seen over the last number of years, some of these may seem obvious, but claiming VAT on non-deductible items. So that's claiming VAT on food, drink, entertainment costs, motor vehicles, or if you're involved in a business activity which is partially or fully exempt, you have limited or no VAT recovery, so you're not entitled to recover the VAT on those costs. Not being in receipt of valid VAT invoices. One thing I would say is that the VAT invoice is the cornerstone of the VAT system, and it is the only document that allows you to claim a refund of VAT. So it's absolutely vital that you hold a valid VAT invoice in order to claim a VAT deduction. And if your invoice is not valid, then revenue can deny the input credit. So some of the issues you see around invoicing not being correct is that obviously, your date, you have to have a sequential number, the VAT number of the supplier, details of the goods and services, your net VAT and gross amount, the VAT rate applied, and the actual value of the VAT must be expressed in euros. Now, your invoice can be in any currency you want, but the VAT element must be expressed in euros on the invoice. And if any of those type of requirements are missing from an invoice, then technically revenue can be in a position to deny your input credit in relation to the VAT you're trying to claim on that. I would also caution that if you were raising invoices, it is absolutely vital that you've all that information on your invoices going out to your customers as well for the same reasons. Another area that keeps cropping up on VAT issues is property transactions. Now, property transactions are a particularly complex area of VAT, and it's fraught with danger. And given the high values involved in terms of property transaction, getting it wrong can prove to be very costly. And the typical things you see in property transactions are you've property sales, you've leases, there's assignments, surrenders, variations to leases, tenant fit outs, end of lease payments, the capital goods scheme itself. And these are all particularly complex areas from a VAT perspective. And as I said, getting it wrong, given the values of properties, can be a significant cost to businesses. And the key takeaway from that, I think, is that, make sure you get proper VAT advice whenever it comes to any property transactions. The next one that I want to talk about is just international transactions. So on the supply side, typically, as a general statement, if you issue an invoice to a business outside of Ireland, broadly speaking, that invoice can be zero rated. There are specific cases where you should be charging Irish VAT, but as a broad statement, invoices going outside of Ireland are typically zero rated. Now, there are specific conditions that apply for the zero rating to apply. So you need to have your customer's VAT number. You need to check that that is a valid VAT number itself. You have to give an indication on the invoice that the reverse charge applies. You should quote the VAT number. And one of the more fundamental things that's come up in the last few years is that in order to avail of zero rating for supplies of goods to other EU member states, you have to file your VIS returns. So you can have done everything right from a VAT perspective, zero rated your invoice, but if you don't file your VIS returns in relation to that supply, then technically you're not entitled to charge the zero rate of VAT, and revenue can come looking for Irish VAT at 23% on that supply simply because you didn't file a statistical return. So, in terms of dealing with foreign businesses on the sales side, that would be a key takeaway. In terms of receipt of invoices then from businesses in other jurisdictions, again, as a broad statement, those invoices should be zero rated, except in very specific circumstances. So if you have a supplier in another jurisdiction or another EU member state or another third country that has charged you foreign VAT on an invoice, the first thing I would be looking at is to make sure that that VAT is correctly charged, because in most cases, foreign VAT should not be charged. And the difficulty you have is that if you pay that foreign VAT, it can be next to near to impossible in some countries to get that VAT back. So you just need to ensure that you haven't been correctly or incorrectly charged foreign VAT in the first place. Another area that keeps cropping up, I suppose, is the self-accounting exercise that you have to do. So this is if you have correctly received an invoice from abroad and it's zero rated. You typically have to self-account for VAT on the receipt of that invoice from abroad. So, you charge yourself VAT, and if you're entitled to claim a deduction, you claim the deduction, so there's no net liability on it. But where issues do arise is that if you are a business that has limited or no VAT recovery, so if you're involved in exempt activity and you receive a service or a good from abroad and you have to carry out a self-accounting exercise, that results in a VAT liability. So you kind of underclaim VAT if you're not dealing correctly with invoices from abroad. And you might say, well, I have full VAT recovery, so if I didn't do it, there's no net loss of VAT. And that's correct, I suppose. But technically, your VAT return is still incorrect because you haven't carried out the self-accounting exercise. And as well as that, there's just a reminder to complete the e-boxes, the 4 e-boxes underneath the VAT return itself, when you are doing your self-accounting exercise. VAT on importation, this is still cropping up frequently on cases where goods are being imported, particularly from the UK, because it's our nearest trading neighbour and it's no longer in the EU. So any importation of goods into Ireland, we are seeing frequent incorrect completion of the import declarations. And obviously, if the wrong importer is put on these declarations, it can limit or restrict your ability to recover the import VAT that you may have paid on the importation of goods. So you just need to be very careful that whoever is completing the import documentation on your behalf in relation to the import, that documentation is correctly completed with your name as the importer stroke consignee, if that's the case, to enable you to recover the VAT charged on importation. The next thing then, and it probably relates to what we were talking earlier about VAT rate changes, is that we do see situations where, VAT is charged at the incorrect rate. And as a quick summary, I suppose there's 4 rates of VAT in Ireland. You've got 23%, 13.5%, 9%, the zero rate of VAT, which is a rate of VAT, and you've exempt transactions. Now, this is more problematic in some sectors rather than others. Some businesses, it's just 23% flat. But if you're involved in particularly retail space, hotels, other type of industries where you have a number of different supplies at different VAT rates, then it can become problematic to ensure you're in charging the correct VAT rate. So we would recommend there that if you're involved in those type of activities, that you do at least once a year carry out a rate review to make sure that every product or services that you're selling are at the correct rate of VAT. Another area that crops up and particularly comes up in revenue interventions is this 6 month rule. And to recap broadly, what that relates to is if you incur VAT on an invoice, you immediately become entitled to recover that VAT. And that's the case whether you actually pay your supplier or not. So if you've a receipt in, you become entitled to, or an invoice in, you become entitled to deduct that VAT. But if you have not paid that supplier within 6 months, you have to repay revenue, the VAT that you previously claimed as a credit. So they give you an opportunity of 6 months in which to pay the VAT on which you have claimed a deduction. And if you do not pay the invoice or the VAT on the invoice within that time, you have to repay that credit to the revenue commissioners. Now, the good news is it's not lost once you do pay the invoice. So if you pay the invoice after 9 months and you pay the VAT in it, you can then take another adjustment and get back the credit that you previously repaid. And as I said, it is something that revenue, typically you will see them now when they're doing a revenue intervention. They do look for kind of a creditors listing, and they are specifically honing in on creditors that are more than 6 months old. And the reason for that is they're looking to see, well, did you repay the VAT that you took a credit for previously? Another area that crops up quite frequently in when it comes to VAT compliance is non-filing of the statistical returns. And the situation is here, I suppose, is that there's no liability attaching to these returns. So typically they can fall behind when it comes to dealing with the compliance in these, but it is becoming more and more vital that these returns are actually filed. So the three that crop to mind are your VIS returns. And they are important not only because you need to file the statistical information, but as I said earlier, if you don't file your VIS returns, technically you're not entitled to zero rate an invoice. Your Intrastat returns, and the annual return of trading details. And because since everything is now gone to e-reporting and e-filing, the non-filing of these is an awful lot easier for the Irish tax authorities to pick up on. And what we are seeing is that, if you're in a situation where you haven't filed these returns, number one, you're potentially leaving yourself open to penalties for the non-filing of statistical returns. But as well as that, you can have situations where VAT refunds that you may be entitled to are being withheld. If you're a subcontractor in the construction sector or forestry or meat processing, and you're subject to RCT, your RCT rate can be increased by not filing these returns. If you're in a situation where you need tax clearance certificates, tax clearance certs may be withheld if these returns are not outstanding. And also, if you're involved in phased payments arrangements with revenue, that's where you've an old debt and you're paying it off by installments, you cannot initiate that process until your outstanding returns are filed. So I suppose they're the downsides. In terms of potential opportunities then, are areas where you could look at maybe increasing your VAT recovery. There's a couple of opportunities that people can look at. One of them is your bad debt relief. So if you claim a refund of VAT where you previously accounted for VAT, but you were not going to be paid, or you haven't been paid, and it's fundamentally known at this point in time that you will not be paid, you can look at putting in a bad debt relief claim for that VAT. In certain situations, I think the default position broadly is, unless you apply for it, that anyone that gets a VAT registration is on the invoice basis by default. But you could look at maybe it would be more beneficial to be on the cash receipts basis, or changing from the invoice basis to a cash receipts basis. There are some key criteria around that, and that your turnover has to be less than 2 million, and 90% of your sales has to be to non-registered people. But there is an opportunity there. I mean, broadly, if you're on the invoice basis, whenever you issue an invoice, you have to account for that VAT. Whereas if you're on the cash receipts basis, you only account for VAT when that cash is received. So there's a cash flow benefit in considering a move to the cash receipts basis if you're entitled to do so. VAT groups is another area. There's a potential saving there in some scenarios for businesses involved in exempt activities. And if you can group them together, there is potential for some VAT savings there. VAT 56B authorizations, if you are involved in a business where 75% or more of your turnover is related to the supply of goods out of Ireland, then you may be entitled to a VAT 56B authorization. And what that means is it's a certificate you get from the Irish tax authorities, and you provide that to your suppliers, and they don't charge you any VAT on the supplies they make to you. So there's a potential cash flow saving there if you think you may be entitled to obtain a VAT 56B authorization. The next item then, I suppose, and despite what I said earlier about VAT not being recoverable on accommodation and entertainment and cars, there is limited VAT recovery on accommodation if it relates to attendance at a qualifying conference. So if you've hotel costs or VAT on hotel costs because you were at a conference in Ireland, you can get the VAT back on those. Potentially, you can also get 20% VAT recovery on fuel-efficient motor vehicles, subject to certain CO2 limits, and there has to be 60% more business use. So again, there is limited VAT recovery in relation to particular motor vehicles if you fall into those categories. If you incur foreign VAT, and this is foreign VAT that's been incurred correctly, there is a mechanism to get that VAT back via an electronic VAT reclaim. I'll talk later on about the time frame involved in getting those back. But if you have incurred foreign VAT, there is a mechanism to get it back. In terms of other benefits, then you can look at the timing of your invoices. So again, as I said earlier, if you issue an invoice, you have to pay the VAT liability on that invoice, even if you haven't been paid. But in certain scenarios, and there is quite specific scenarios where this would apply, but you could potentially look at maybe issuing a pro forma invoice or a request for payment rather than an invoice. And in that situation, all you've done is you're looking for payment of your customer, but you haven't raised an invoice, so you don't have to account for the VAT. There are some rules around that, but it is something that you could potentially look at rather than issuing invoices and waiting to be paid if you know there's going to be a delay in payment. You can look at your VAT filing frequency. There are, everyone by default is on your bi-monthly period, but there is some reduced VAT filing frequencies depending on what your annual VAT liability is. So you can look at doing quarterly or 6 monthly returns in certain scenarios. And finally, then, in relation to just some opportunities for industries that are involved in partially exempt activities, so in other words, they've limited VAT recovery, you can look at the VAT input recovery methodology that you are adopting. I mean, the standard and default is you look at your turnover and you say, well, my VATable turnover over total turnover is X. So therefore, in relation to some of the costs, I can recover X% of those costs. But there are other methodologies that may be more suitable to your business. You can look at, say, the staff that are allocated to certain sectors of the business. You can look at the square footage of the business. So in other words, what area of the floor place of your office or your factory or whatever is taken up by what activity. So you can look at other options in terms of your VAT recovery methodology to potentially come up with a higher VAT recovery that you can then apply to your costs. Finally, then, in relation to some other aspects to do with opportunities around VAT, if you do find you're in a situation where you have VAT errors and, you immediately go to, right, we've discovered a VAT problem and we need to make a qualifying disclosure, pay the VAT, pay the tax, pay the interest and penalties. And sometimes people go off on that route without considering there are other options within the Revenue Code of Conduct for addressing if you have issues from a VAT perspective. So, sometimes the VAT or the interest or the penalties do not always apply, depending if you can meet key criteria for certain aspects. So there are things like the no loss of revenue argument. And in that situation, the VAT or the interest does not become payable. You can look at self-corrections. And if you meet the criteria for that, again, no penalty applies. You can look at correcting an innocent error. No penalty applies in that situation as well. And you've technical adjustments. And again, there's some key criteria around that. But there are situations there where no penalty applies if the error arose as a technical adjustment. So I think it's just a word of caution that, if you do have errors from a VAT perspective, don't necessarily rush into a disclosure. There are potentially other options within the code of practice that allow you to address the situation, with not having to pay interest or penalties, or in some cases the tax itself. Finally, then from the VAT side, I suppose in terms of upcoming dates, watch out for those VAT rate changes that are coming down the line or that have come down the line and may not be implemented in your system. The annual return of trading details for the December year end was due on the 23rd of January, just gone. So if you haven't filed that, bring that up to date. Your annual VAT recovery rate exercise for December year end. So this is again if you've got partial recovery in relation to 2025, you need to do a true up after the year end. So people are starting to look at that around now, or maybe even going into March once they have their 2025 financials done and they have a handle on what the income is. And any adjustment, either positive or negative, in terms of what VAT you did recover in 2025, you have to include that by the latest, by the May-June VAT return. Electronic VAT refunds, this EVR claim for VAT refunds that you've incurred VAT in foreign jurisdictions, you have up until 30th of September 2026 to recover that VAT in relation to 2025. So there's a deadline of September there for that. And the VAT 56B authorizations then that I spoke about earlier, they're typically renewed in October. So if you feel you may be in that space, the application should be in by October to cover off that. And I suppose long-term deadline, as I said, the e-invoicing protocols that are coming down the line. So that's all from the VAT side for now anyway. So I think I'll hand it to Jeff.
Thanks, Kieran. Lots of helpful information there on the VAT side. So I'm going to be speaking on the Revenue Commissioners versus Karshan Supreme Court case from 2023, which has provided a new framework for determining employment status of an individual, whether they're a contractor or, in fact, an employee, which can be determined regardless of the paperwork that is in place. So a bit of history around the Supreme Court case finding in 2023, which goes back a lot further. So in October 2018, the Tax Appeal Commissioners determined that Domino's Pizza drivers were engaged as employees and not as contractors. And that related to an assessment for 2010 and 2011. Then in 2019, it went to the High Court, and the judgment provided for four core issues to determine employment versus a contracting relationship. That being mutuality of obligation, substitution, integration, and in examining the appeal, the High Court also assessed whether the Tax Appeal Commission had failed to give proper weight to the actual terms of the contracts in question. And the High Court upheld the decision of the Tax Appeal Commission that it was an employee relationship rather than that of contractors. Then in May 2022, when it went to the Court of Appeal, the decision was overturned, that High Court decision. So that is what led to this case going all the way to the Supreme Court. And in October 2023, the Supreme Court found that in the Karshan Midlands Limited, which is Domino's Pizza for the Midlands region, and it's the appeal and the assessments raised by Revenue that they were in fact employees, that it was an employee relationship, and they set out this new five-step framework, which is replacing a historical method of determining whether there's an employment or a contract relationship. So then in May 2024, on the back of the Supreme Court finding, Revenue released a new five-step decision-making framework, which is based on the decision of the Supreme Court. More recently, in September 2025, Revenue announced a disclosure opportunity for employers for the 2024 and 2025 years that they could address any misclassifications of individuals as contractors where they should be in fact treated as employees under this five-step framework. And that disclosure window was open until the 30th of January 26, and so it's expected now, given the timeline of the Supreme Court decision, Revenue having issued their guidance and this disclosure opportunity, that for 2026, Revenue are expected to ramp up their compliance interventions. So that's aspect queries, risk reviews, and full-scale revenue audits in relation to the employment status of individuals. So before the disclosure opportunity between September and January, Revenue had previously encouraged all businesses, after they had released the guidance on the five-step framework, where they are engaging contractors and other workers on a self-employed basis, to familiarize themselves with the details of the judgment and the five-step framework, and whether they needed to review whether individuals who were contractors were in fact employees. And in e-briefs that have been issued since then as well, Revenue continued to remind businesses that it is they, the businesses, who are responsible for ensuring correct payroll taxes are deducted from employees' pay through the PAYE system. So what is this five-step decision-making framework? So the first considers the work-wage bargain, which effectively just asks whether the contract involves an exchange of a wage, pay, remuneration for the work being done. And that's the term of mutuality of obligation that's referred to. Then the second step is looking at personal service. So if there is this work-wage bargain, is the agreement one where the worker is agreeing to provide their own personal services, or a third party, and are they replaceable to the employer in question? Then the third step considers control. So looking at the first two steps, if the answer is yes in both of those cases, does the employer exercise sufficient control over the individual to render the agreement one that is more an employee arrangement rather than that of a contractor being engaged? And then step 4 and 5, they look at where you have yes as kind of the answer to the first three. Are the facts consistent with a contract of employment versus a contracting arrangement? So, looking at the material facts, how that compares to the paperwork that's there as well. And then the legislative context is effectively, considering, is there any exemptions where we've gone through the framework, but is there any legislative exceptions to where, even though you might be considered an employee, in the legislation provides that it's actually not included. So in the guidance issued from Revenue in 2024, they provided a number of examples from different sectors, and it's helpful in terms of determining, in different scenarios, whether someone should be considered an employee or a contractor. So in this example, they look at a plasterer for B company, and B company is a building company, and he provides labour, and he's paid on a daily basis. He takes instruction from a site foreman, and he's not free to replace his work with someone else. So considering the five-step framework in this example, on the work wage bargain, it's that condition is met because he's being paid daily to undertake the work. Then in terms of personal service, as Richard cannot send someone in his place to do the work, that is also met. And in terms of control, that's also there, as we're told in the example that there is a foreman instructing Richard. And then, regardless of whether Richard and the paperwork around the contract was him as a subcontractor, all the circumstances and the fact pattern actually indicate that Richard is an employee and not self-employed. And because there's no, legislative exemption to this, we don't need to consider point 5. So in that case, Richard is to be considered an employee, and POE and employer's PRSI should be applied by the building company. Then in another example, they provide an example of an electrician. Slightly different fact pattern, where the electrician in question they do provide their labour, but they also provide their own materials and tools, and they're paid a set fee for wiring houses. The instruction on wiring the houses is from the foreman, but there's no restrictions on who has to do the work, whether it's Peter or someone that Peter can employ instead. So yes, there is a work wage bargain, but there's no personal service as Peter can replace who does the work instead of him. And the control aspect is not considered to be met either. Um, so in this scenario, in revenues guidance, Peter's considered to be self-employed, and payments to Peter as a subcontractor are to be reported and RCT operated in this case as it's for construction sector. Then just considering some recent Workplace Relation Commission decision. So there was the famous Fiddler case that was in the media around a year ago. So in that case, a fiddler as part of a band played regular gigs for 8 years, and he was terminated without notice when he applied for the pandemic unemployment payment during COVID, because this is the time that he lost his work. The Department of Social Protection considered his employment status, and he was held using this five-step decision-making framework that he payment. And from the revenue guidance as well, it's clear that revenue have certain sectors in mind here. So in terms of examples given in the revenue guidance, they call out specifically the construction sector, part-time casual seasonal employees or workers engaged in a domestic setting, couriers and other transport providers, um, people working in media, public sector workers, or there's examples of that as well provided, and platform operators. So revenue do expect that there will be an increase in the number of workers that should be considered employees as a result of this new framework and their guidance issued. So what's the impact for businesses of this new five-step framework? Well, first, revenue recommends that businesses review their existing arrangements with contractors to consider, are they really in fact contractors? And under this framework, or should they be considered employees with appropriate payroll taxes operated? And then if there are these issues, they need to be rectified. And where there's any queries from revenue expect that there's evidence that this five-step framework has been considered where there's any grayness around whether someone is to be considered an employee or a contractor. Business should carry out regular reviews of workers engaged and whether they are contractors or employees. And of course, where someone's employee as opposed to a contractor, then there's a potential loss of employer PRSI to the exchequer, which is a key point where someone should be considered employee. And as said earlier, given the disclosure opportunity, the revenue guidance being published in 24 and the Supreme Court decision being in 23, businesses need to be ready for revenue compliance interventions in this area. So I'm going to pass on to my colleague Frank Green now, who will talk about payroll tax considerations more broadly.
Great, thanks, Jeff. That's obviously quite an important area, I think, in the context of who is treated as an employee or self-employed. And certainly the tax authorities have an expectation in terms that every organization who has somebody who could fit within that category would actually do that type of analysis that Jeff has outlined there. So if you have sort of anybody who is borderline, it certainly would be worth having a look at that and just making sure that it's dealt with properly because the consequences otherwise are quite significant. So just moving on to some just general payroll matters that I wanted to actually go through and just cover a couple of points, just withholding obligations, reporting requirements, some benefits in kind, then stuff on the tax residence, DTR, pension auto-enrollment, and then just in terms of the broad principles involved on the payroll governance side of it. So just in terms of payroll tax, the basic requirement is that an employer will actually deduct, PAYE or income tax, USC, and PRSI and pay it over. That must be notified to the Revenue Commission before the actual payment is made. There's no out for a director of any type in it. And even if it's a non-resident director, Irish tax needs to be operated on payments to a non-resident director. It's something that a number of companies certainly get caught on. So just to be mindful of that. Then just on auto enrollment, I think everybody probably has heard enough possibly about this and the consequences of it, but it is in place from 1 January 2026, and employers are required to enroll employees in that state scheme, where the conditions we set out there, where an employee earns more than 20,000 per annum, an employee is aged between 23 and 60, and the employee is not already paying into a pension scheme to their payroll. And it's that latter one maybe is probably the broadest out that there actually is, for employers. If they already have a scheme themselves, then you don't need to get into it. But yes, it is an additional cost for people, but it's mandatory, so you've got to be mindful of it. On just the taxation of employer provided benefits. And this is an area which there is a fair amount of current revenue scrutiny on, because in the course of tax audits that they're carrying out, they are coming across situations where when they're looking for details of all assets owned by a company, particularly motor vehicles, they're getting information. They're getting details of vans. They're getting details of pool cars. They're getting details of ordinary cars, and then they're following that through to see what BIK has been provided. So, if an employee is provided by an employer with, any sort of benefit at all, well, then that benefit is liable to taxation. So, irrespective of the nature, unless there is a specific exemption, and there are a couple of items, and I'll touch on that later on insofar as what's actually there. So the main ones are obviously, cash or goods convertible into money. Cash in its own right is not a benefit. Cash is liable to PAYE and should be operated through the PAYE system. And it's the market value that's generally applicable to it. And where an employer is providing some of its own goods or services to its own staff, then the benefit in kind is normally applied based upon the actual cost to the employer rather than what the cost would be to a third party. So that's something just to be mindful of in certain types of industries. So in just the broad principles, and I won't get into the technicalities of what's involved in it, there's various sections there that cover charges that are actually in it, and there's reasonably good guidance as well on that. So you just might, yeah. So in terms of some of the exemptions that are actually mentioned there, and this particular one probably is the best known one of all, and this is to do with what's called the small benefit exemption. That currently is an amount of up to €1,500, where essentially you can give a voucher or vouchers or benefits of up to 5. It used to be 2 and capped out at 1,000. It's now 5 benefits in a year and capped out at 1,500. That's actually quite a good benefit if somebody wants to look at a very tax efficient way of actually rewarding employees. Now, there's obviously obligations that go with that. It needs to be tracked. Does need to go in under the enhanced reporting, which I'll touch on separately. But just in terms of the areas to be mindful of it is limited to the first 5 benefits in the year, and so you cannot pick and choose benefits. So if you give a benefit to somebody, an Easter egg, that's a benefit. Might be €5, whatever. So you could easily use up your benefits, because most people, you could use them up well before the year end. I mean, many employers will give, vouchers or the larger vouchers to people coming up in or around Christmas time. And when you're looking at that, sometimes the concern would be have you already gone over the 5? And that's why it was, brought up to 5 from 2, because it was quite difficult. It needs to be tracked. And the employer cannot choose which benefit to apply the exemption to. As I say, it is literally the first 5, and that's it. And I'd touch as well, maybe just separately, on salary sacrifice. It cannot be part of a salary sacrifice arrangement. which basically is a reduction in salary to give a tax-free benefit. You can't actually do that. It must be separate from, and cannot be contained, within an employee's a contract of employment, and shouldn't actually be in there. But it is a very valuable benefit. Just on the employer-provided vehicles, which I touched on a moment ago in the context of the issues that arise on the BIK, there are various exemptions depending upon the nature of the vehicles. There is some exemptions that we've listed out there, and reductions in the BIK for electric vehicles. That's been around for a while. The other one to be mindful of as well is that there is, and there has been since COVID, a 10k reduction in the original market value of cars in certain categories, which essentially means it's the benefit in kind on the first 10k is essentially tax free. Now that's actually the last year for the full 10k is 2026, and it's been reduced to 5k in 2027 and 2.5k in 2028. But if you are doing payroll, just be mindful, and if you've provided cars to employees, just be mindful that you've taken that into account, because in some instances I've seen it where it hasn't. The other element to be careful about as well, and I mentioned, the type of vehicles that can arise, could be a car, could be a van, could be a pool vehicle. There are situations where people are treating certain types of vehicles as vans when in fact they're not vans. The sort of classic one that I've come across would be the Land Rover Discovery, where people think that those are a van and not a car. That's been determined in front of the tax appeal commissioners that they're in fact a car, and the higher BIK applies on them as well. So as I said, be mindful of what actually happens there. Now, the benefit of a van clearly is much lower BIK rates. So it is the 8% of the original market value, and you still get the 10k reduction in the years up to 2026 there. So that started out back and it was in place in 2024, but it's been renewed recently and applies up to 2026. So then, just on other benefits, the other one you come across at times is, which can be quite expensive from a BIK perspective, is loans to directors or employees. The rate on those in general, the BIK rate is 13.5%, which is per annum, by the way, as well. So it's not a once-off charge. The 4% only applies to a loan in relation to the, purchase, improvement, or repair of your principal private residence. So that's not very common. But the other one can be really expensive. So if you give, a loan to an employee of €10,000, there's a benefit each year of 1,350, of which they pay full tax on. And that can add up over a particular period of time. If there are loans to directors and shareholders, there's another piece of legislation you need to be conscious of as well, where you got to give a loan to the revenue under corporate tax rules, but you get it back when the actual loan is actually repaid. And that actually, the BIK and loans also, you can't give it to a spouse. There's connected party rules that are there as well. So I touched on the salary sacrifice. This is a thing that the revenue commissioners do look at. It can apply where people are trying to get in with the €1,500 tax-free voucher. It can also apply in situations where if somebody wanted to put higher amounts into pension, take lower salary, higher amounts into pension. There are provisions where if it's a bona fide alteration that's going to apply in the longer term, and that is actually in a new employment contract, that is okay, but you cannot just chop and change every year, and you cannot certainly make retrospective alterations to what's actually involved in it. So that's something just to be careful about when you're looking at remuneration packages for employees or staff. It has to be a genuine situation. Otherwise, you'll have full BIK on the benefit foregone. So then, just in terms of some of the areas that the revenue are focused on currently, certainly Jeff mentioned some stuff on the employed versus self-employed. That's certainly coming down the track. I mentioned the details on the cars. They're certainly looking at that in terms of the BIK. business mileage logs, details, ownership of cars, whether it's a pool vehicle, whether it's a van, staff discounts as well. If there's audits going on, you'll get a list of questions in terms of it. The small benefits exemption, whether that actually all the terms and conditions are being adhered to. And then there are other benefits that are there, the bike to work scheme, health checks, just make sure that those come properly within it as well. Expenses as well. This is another one that has to be reported under the ERR. Expenses are, in the general sense, under tax legislation, is very tight, very difficult in reality, and very narrowly focused because of the wholly, exclusively, and necessarily in the performance of the duties. Most expenses that you can pay out are actually done by way of concession by the revenue, and legislatively you don't really have a foot to stand on in relation to it. But the other thing to be mindful of as well is make sure there are proper, controls and processes and procedures in place around expenses. Make sure there's claim forms and backup documents, and that in fact, if you're not using the civil service rates, make sure it's vouched backup receipts for what's actually happening. Be mindful as well of normal place to work. This does arise where particular, sectors, salespeople, people in the construction sector, remote workers, period of time that people are spending elsewhere. You need to, as an employer, keep records of all of that. Just a couple of things there in recent revenue audit stuff. They're certainly looking at the employer reporting. In fact, letters have gone out to a lot of organizations who have not made any of those reports to do with the benefits and expenses, plus the €3.20 per day for working from home. They would expect that most employers would have some expenses of that nature. That is an obligation, and that's something that will be followed up on. Home to work is another area where you cannot actually get, from home to work. That's not an allowable expense. Private tolls as well, which are actually related to that. There are some areas around subsistence expenses, country money, where the workplace is not temporary. So you just need to make sure that you comply with all the detailed conditions that apply to those particular specific areas. And then just on the enhanced reporting which came in, those are the three items I mentioned there, which is the remote working daily allowance $3.20, travel and subsistence, and then the small benefits exemption. All of those must be actually submitted to the tax authorities, and if you don't, they will come looking for them. That's details of what needs to actually be reported. I won't get into the detail. I think people probably are broadly aware of the various elements. Probably the first column is the one to be most mindful of, insofar as where it's vouched, run vouched travel, subsistence, site-based employees, emergency travel, eating on site. All of that information must be provided. The other ones are a little bit easier to actually comply with. And on that, in terms of the compliance interventions by revenue, I mean, that's just a bit of a history in relation to, I'm not going to get into the detail. Where we are now is we're probably at the intervention stage. And it's important that every employer would have their house in order just to protect themselves in relation to, there are penalties that apply if the returns are not made. And then just a couple of changes in the Finance Act 2025. Not necessarily all tax related. The increase in the minimum wage impacts on people, the changes to the USC as well. There's some benefits or some reductions that were there. PRSI has increased too, just to be mindful of that. And there's further increases coming through. And there is increases in the foreign earnings deduction as well for people who are actually traveling abroad. So those are some of the particular items on the payroll side. Likewise, some stuff on the SARP. So people who are actually sent, to locations and who are coming to Ireland here to work, they can get benefits from that. The 10 grand that I mentioned on the company cars, that's actually in place until 2026, with some reductions for 27 and 28 as well. And some stuff on the KEEP programs for people too. So that's broadly speaking, trying to keep within the timelines that we had on it as well. So that's a broad sort of brush approach to what's happening on the payroll side of it. A lot of stuff in there to take on board. And if anybody has any questions, feel free to actually give them to us.